definitely want to own gold, and you can add in on occasion silver and platinum in there too. But that has to be when the level of real interest rates is falling. So if nominal rates have topped out, and I think we're no longer in a sharp deflationary environment, that's the time you want to really lever up on gold. Take it all the way to 20% in the portfolio.
In today's episode, renowned financial strategist Michael Pento predicts a dire economic scenario, foreseeing the current $2 trillion deficit ballooning to a staggering $6 trillion. In his latest interview, Pento cautions investors about the potential carnage looming over both the stock market and the broader economy as debts undergo refinancing. Pento emphasizes the need for patience in the face of economic changes, pointing out the misinterpretation of macroeconomic signals as most experts struggle to understand them. Michael raises awareness and explains his concerns regarding the labor market, potential job cuts, and a housing market downturn, signaling a slow-moving train wreck that could manifest as a recession in 2024. If you're into commodities, this video is for you. Please like, subscribe, and turn on notifications to let us know that you like the video, and check our pinned comment for some massive sign-up bonuses with our official partnership deals. Let's get into the video.
Well, so there is no commodity sector in the mind of Pento portfolio strategies. There's precious metals, and there's base metals and energy. So there's two different categories. I wouldn't conflate the two. So in a recession, depression, disinflation, deflationary environment, you would get out of base metals and energy. You'd be short those things. They always get destroyed. When the R squared, the correlation goes to 1 in that environment. However, gold is money. It's a currency, and it has a different volatility dynamics than, say, copper or oil.
Yeah.
So I separate the two. I definitely want to own gold, and you can add in on occasion silver and platinum in there too. But that has to be when the level of real interest rates is falling. So if nominal rates have topped out, and I think we're no longer in a sharp deflationary environment, that's the time you want to really lever up on gold. Take it all the way to 20% in the portfolio. I'm not there yet, but I plan on getting there. With the caveat, though, and I alluded to this. So if you look at the direction of real interest rates are rising in a deflationary collapse of the economy. And that's why you see at times, you'll see gold is just used as a liquidity asset. So you just dump it because you have to wait. What do you need? Everybody needs one thing. They need dollars. They need cash.
Yeah.
And so they dump everything they can. So outside of that, once nominal rates top out, gold is an excellent investment. And so I'm looking to increase that until we reach that liquidity event. And then on the other side of that liquidity event, that's when I think that's when I think gold is going to be going to all-time record highs. Because what you'll see then is you'll see a never-ending regime of interest rate repression. In other words, the only way that the U.S. government can maintain any semblance of solvency is to have the central bank print money to buy bonds, just like the Bank of Japan's doing, to keep nominal rates from rising. And when you have nominal rates capped and inflation is rising, what happens to real interest rates? Well, they plunge, which is the absolute sweet spot for physical gold and even the miners at that point. So
today witnessed significant volatility in the spot gold price, briefly surpassing the noteworthy $2,000 mark before slipping below. The initial ascent saw gold reaching $2,648. However, this momentum proved short-lived, with shifts in investor sentiment triggered by recent U.S. economic data. Key factors influencing market dynamics included a report revealing a decline in jobless claims, reaching a 5-week low at 209,000 and indicating a tighter labor market. Concurrently, fluctuations in Treasury yields, known influencers of non-yielding bullion, played a role. The University of Michigan's inflation expectation report further contributed to the mix, indicating consumer anticipation of a 3.2% inflation rate over the next 5 years. This projection holds significance for Federal Reserve interest rate decisions, reflecting ongoing concerns about inflation entrenchment if expectations remain elevated. Now we'll show you more clips of Michael Pento and his interesting insights on the market. Watch the video to the end, hit the like and subscribe button to let us know that you like the video, and feel free to support us using our referral links in the pinned comment if you want to add crypto to your portfolio. Now let's get into the video.
That's what I'm looking out for in 2024.
Okay. And in that scenario, I mean, 20%, but you also, would you look at like a GDXJ? Would you look at equities as well? How do you play that?
As I said, the miners, that's when the miners really come. Miners are just a leverage play on gold, much higher volatility dynamics than the actual, physical gold. So you got to be very careful, because there are times, and you'll see this happen before us, how I rigorously back tested my portfolio, and you just come up with some ideas of what to own. When the stock market goes down and cratering as it evolves into a liquidity event, you'll see people, gold miners are stocks, and they get sold.
Everything, yeah, absolutely.
Everything gets flushed down the toilet, and they get hurt badly. Where physical gold will hold up much better in that environment.
Okay.
I want to say, I don't want to forget this one thing. We have a massive valuation problem. I call it a triumvirate of bubbles. So you had the mother of all bubbles in bonds. You have a massive equity market bubble, and you have a real estate bubble, all existing concurrently. That has never happened before. When in global financial crisis, you primarily had a housing market bubble. You didn't really have an equity market bubble. I mean, the total market cap of equities was 100% of GDP back in 2007.
Okay.
Today it's 160%.
Sure.
So you have a massive, in fact, that 160% total market cap of equity to GDP ratio is the highest ratio that ever existed prior to 2020. Think about that. I mean, it blows away where it was even in March of 2000. Like I mentioned, 17 trillion of negative yielding bonds in the world, and the most unaffordable housing market index we've ever seen. So all three bubbles exist together, and the S&P 500 is trading at 18.5 forward PE ratio. That assumes, if you listen to the Wall Street geniuses, that's assuming that we're going to have a 12% growth rate in earnings in 2024. Now, real GDP is supposed to be 2% growth in 2024. So I don't know. It's just, there's going to be a shock in 2024. Now, it's already 18.5 times the 12% that's projected in 2024. We're already trading at that number.
What do you think of Michael Pento's forecast? Is the stock market overextended? And is the economy set for a massive recession in 2024? Will gold and silver heavily surge in the next year? Post in the comments section down below your honest opinion and send this video to a permabull. Thank you for watching the video to the end. Sub to the channel if you want to support us, and I see you next time.